The third hour of Varney Company is about to begin. All right, in a moment, we'll get some reaction to that editorial from Christian White and State Department guy. I want to know if he thinks Xi Jinping is going to hurt from all of this, and if it affects trade in America's favor. First, though, let's bring you up to date on your money. Doing quite well this Monday morning. The Dow at the moment up 96, 97 points, almost triple digits. We're pretty close to 26,900. Not bad. Our next guest has a problem with the Fed cutting rates even further. David Nicholas is back with us, Nicholas, wealth management guy. If you say that the Fed keeps cutting, we'll end up like Japan in 20 years with negative rates? You're aware, of course, that Alan Greenspan says that if we go to zero rates, it's no big deal. What's your problem?
Sure, Stuart. I mean, we have to be careful, and history should be our judge. Japan has already been through this, so they're a great nation to look at. In 1999, Japan lowered their rates to essentially zero. Well, fast forward, what's happened in Japan over the 20 years? Well, they've had dismal economic growth, less than 2% growth. The Bank of Japan owns 40% of all Japanese government bonds. And here's what's interesting. Japan has the highest debt-to-GDP ratio of all the developed world, over 240%. So what you've seen is that Japan, that's really just been caught in this sluggish growth. They've tried to raise rates. They've been unable to do it. So I say U.S. needs to have cautions that we don't end up like Japan 20 years from now by continuing this cycle of lowering rates to try to come up with some type of utopia for the economy that I think is harder to get to than we think.
But look, our stock market is flirting with all-time record highs. We're only a couple of percentage points away from the Dow, the S&P, the NASDAQ, all-time record highs. And yet we do have very, very low interest rates. I don't see why low rates are such a bad thing if we've got such a strong stock market.
Stuart, you're exactly right. Low rates are great for the market. So I would anticipate the markets to continue to do well in a low rate environment. But it's the other parts of the economy that can hurt. For example, retirees. If you're a retiree right now, and gone are the days where you could go to your bank and get a 4 or 5% CD, where do you go to find yield? So investors are having to take on more risk in their portfolios, which could end up hurting them down the road. The other thing is in asset prices. So we see bubbles in the markets, but we also see somewhat of a bubbles in real estate prices. If you're a young person looking for a home right now, it's getting harder and harder to find an entry home. Why? Because when yields are low, investors flock to things like real estate. They sit and hold on real estate because they know their yields that they can get from rental income is much better than where they can get anything else. So yes, markets perform well, but other parts of the economy can get hurt, and that's the unintended consequences of a low rate environment.
As things stand now, do you expect us to hit record highs soon on the market?
You know, I mentioned last that we would see record highs this year. I think if there's no other major breakdown in trade talks, I think we're close to it. But I do think we'll break another all-time high for the year, Stuart. Hopefully that should excite investors. I think we'll see it without any major headline or breakdown in the trade talks.
You know, if there's one stock that most investors, if they're in the market, most of them have at least a tiny piece of Apple, whether it's through a mutual fund or some kind of fund investment or own the stock directly. They've got a big deal coming out tomorrow where they're probably going to release another new iPhone. You think the stock price is going to go up on this release?
You know, I don't think the phone's going to be anything groundbreaking. They have some PR issues with what's going on in China currently, but I think the stock will continue to do well. Stuart, here's what's amazing about Apple, and I've blown away when I looked at these numbers. In 2018, Apple's net income was $60 billion in 2018. That means every single day, Apple profits about $160 million per day. So I think Apple has years to go. They're incredibly profitable. Without some breathtaking or groundbreaking technology, they're still printing money left and right. So I think there's still upside for the stock.
Well, sure. You know, look, we've had someone on this program who says Apple goes to $350 a share in, I think, less than 2 years. And someone else said the thing is going to double in 2 years. Would you go that far?
You know, it's possible. Stuart, they're making so much money. I mean, $60 billion in net income. I mean, it's hard to find companies that are that profitable without some type, you know, they've got a user base that is almost cult-like following that continues to buy their services, their phones. So, hey, I think we could see it.
Okay. Do you own Apple stock yourself directly?
I don't own it, but my clients, we own it for our clients, absolutely.
Okay, I missed it, by the way. My kids were telling me to buy Apple when it was at 57, pre-several splits, and of course I missed it and I never got back in. David, thanks for joining us. We always appreciate it, and we'll see you again soon.
Thanks for having me.